And now it says that it's loading.
There we are.
Oh yeah, there
Okay.
it goes.
All right. So I thought what I'll do is I'll run through some of the basics here just in an abstract sense, and then we'll dive into some charts and kind of have a look at how that works in reality. So I thought I'd begin with a little poem, really, which is something that I was taught to memorise back in my very first year at high school over here, and it's a poem by Kipling. It's essentially about curiosity, but it's ended up with some lifelong principles that I've followed and I still follow to this day, and it's I keep 6 honest serving men. They taught me all I knew. Their names are what and why and when and how and where and who. And if you read the full poem, it goes on about how in adulthood we tend to forget some of those basic questions, and how in childhood you rattle off about 7 million a day. And that's how, but there's still 6 kind of key questions I think that I was going to try and answer today, all about high tide flags for you. So to keep your curiosity alive and you're learning up. So what is a high tide flag? Now, at its most basic, what it is a move of 100% or more, followed by a retracement of 25% or less, which is then subsequently followed by a move of 100% or more again. Now, the timelines kind of associated with that is you would expect your 100% plus move to occur within the last 8 weeks. And there's no prescriptive timescale on that. It can be a 2-week move, or it can be a full 8-week move. And you can stretch the boundaries of those a little bit, but then they tend not to work so well. The retracement should be smooth, and you should see the lowest point of your retracement 3 weeks. So it should retrace up to about 25% within the next 3 weeks after the high point. And that is where you get your binoculars out and you start looking for an entry at that point. If it goes a further 5 weeks without an entry, is then a broken pattern. Also, if it dips below that 25% retracement value, it's also a broken pattern. But other than that, the pattern is valid. So, kind of in reality, these things can look a little bit more messy than a straight line drawing. And they can have slightly different looking poles and flags. There'll be ups and downs along the way. Things don't just go straight up. But they do all adhere to the same basic anatomy. I've got a spelling mistake in there, I see. Dyslexia coming out. But there's an example there on the left of how we look in the chart, and one often follows the other. But the first one was a flag that subsequently then went up another 100% dips down, and I traded this one 3 or 4 times. But again, you can see how it dips down, and then again off we go. We get another 100% move on it. So that is the how they kind of look, but they also all look a little bit different, but you just have to take the basic overall pattern. So why do I trade these things? And maybe what should you think about when you're looking at these types of patterns? So it's a couple of key things for me. The first one is that you're always trading with the trend. A high tide flag, by its very nature, has made a move of 100% plus upwards, and that is so it's already in that proven uptrend. So you don't have to wonder whether or not you're you're in a stage 2, 3, 4, whatever like that, you know you're already in a stage 2 uptrend because you've moved 100%. So you're trading with the wind behind your back, which is a great thing. Of all the patterns that people look at, these have the highest potential gain. And I'm talking here in a short-term swing trading sense, rather than a buy and hold or a medium or long-term trade. But all high tight flags have a target move of 100%. That's what the pattern is saying to you. I've moved 100%. I'm retracing. I'm going to go another 100%, and so they've got the highest potential of any patterns, which is why I started trading them almost exclusively for a while, and why I call them the account, sort of the ones that really grow your account, and because they do have that highest potential move. And if you get in on one, then chances are you'll get in, you'll exit around about 100% plus on your position, and it'll set up again, and you'll do it all over again. So once you get a good one, then you can stick with it through 2, 3, 4 moves. Until it has a kind of base break, as I think O'Neill would call it, and they all do eventually, and then start breaking down. But when you get them, they're pretty good. If you go to, I don't know if any of you use the Bulkowski site, or Bularkowski, I think it is, rather than, I've got Bulkowski there, but he does he's got a website which essentially, and he updates it every year, with all the patterns and the classic entry points and the moves that they make. And it's one of the ones with the highest probability. You've got a 45% chance on any high tight flag to go 30% or more from the classic entry, which is the flat top entry. So with those three things, you're already on a pretty good, pretty safe bet, I think. The other thing is when you then want to start finessing some of the entry points and so on within high tight flags. And I trade them slightly differently from the classic way, and more in line with the kind of life's ready style of entry. But there are multiple entry points here. So there's a classic one, which is a break above that high point, which will normally happen somewhere in the 3 to 8 week mark. You often find multiple pivot points when it starts coming off the lows somewhere after the 3 week mark. There's many pivot points, or low cheat entries, which tend to be the ones that I tend to use. But you get multiple chances to get in on a stock if it's done something that's if it's had one of my sort of 6-day reset type moves or something, then I'll just sit and wait for the week and look for the next potential entry on that particular one. In terms of recognition, they're very simple to scan for and recognize. Once you get that big move up, steady retracement in less than 25%, and then looking for another big move, and you get the timeline piece set out, so 8 weeks for your big move, 3 weeks for your, the low point of that retracement, and then they're very easy to recognize when you look through them. Now, maybe that's just because I've looked at tens of thousands of these things, and for someone that hasn't seen one before, it might not be quite so simple, but this is one of the key reasons that I like to trade them, because to me, I just can spot them at 100 paces. And then morphability, maybe not even a real word, but essentially high tight flags, when they break down, they have quite a high probability of breaking down either completely, in which case they're right off your radar, or turn into what's called some people call a rocket base, which is generally a long drawn out base pattern that would have essentially a more than 25% retracement but less than 40%, and anything up to 4 or 5 months worth of basing, but they can be quite powerful when they actually come out. So again, when you scan and find these high tide flags, they tend to stay on your watch list for a long time, and you often feel you're looking at the same names for 6 or 7 months, within those kind of watch lists, and you often are for those reasons that we've just put in there. So they tend to work straight away, or if they break down, then you're looking at them a bit longer term, looking at for where that next kind of rocket entry point may be. And if they do work, then they're on your radar, but then they're still on your radar because they will likely set up again. So that's the whys, and I think they're all pretty valuable or good points, and they certainly are for me, because I want to put my money and I want to spend my energy and my time when I'm analysing things on the things that have the highest potential move, the highest probability of making that move, and take me the least amount of time to analyse and to work out what I'm doing with, and and they're kind of proven, if you like. So that's essentially why I trade them. So I've kind of covered some of this stuff off, but entries, some very basic rules here, and the things that I've seen a lot of people show high tight flags, and they often get them wrong, and I wonder why they get stopped out, and then 3 days later that it takes off without them and things. So, but your entry really should be between 15 and 40 days after the high point. So, they're generally not really worth paying that much attention to as they're setting up, but just keep them on your radar and just keep a little look to what they're doing. The best moves in my experience have all happened when there's between a 15 and 25% retracement. Shallower than that, they tend to sort of run out of steam or not offer good entry points. And any deeper than 25%, they tend to have a stutter part way up. So, and that's the point where your trade's in danger, because you don't know whether to cut it or hold it at some points, because they can be a little bit violent, the reversals, because you're essentially still within a base if you're buying it quite low. All the best ones have what we call a VRD, which is a volume and range decline. So you want to see the volume declining, and volume is an important part of kind of high tight flags, and we'll look at that when we go in the charts. You also want to see a range decline as well. Now, some people may say volatility, which is kind of a mixture of both. But I like to see a range decline, which I measure through the average true range indicator. Generally, you want to see moving averages getting squeezed. A high tight flag, by the way, it operates a 100% move, is going to extend the stock way above its averages. And I'm talking primarily here the 10-day, the 21-day, and the 50-day. So you normally see the 10 and the 20, the 10 curve down towards the 21. 21 will sort of flatten out, and the 50 period moving average will catch up with both of them. And that's sort of ideally your time for your entry. And that takes, essentially that's why it takes sort of 3 weeks minimum before they're ready to set up. But once those moving averages are squeezed together, then all the various market participants are now in potential for getting in on the next move. The traditional O'Neill entry, I call it a flat top entry, but flat, draw a line from previous high, and then it breaks that, and you go. Typical breakout type trade. They are absolutely possible, but you need to have the volume profile if you're going to take that. You need to see some really serious volume kicking in if you're buying it up at the flat top, because there'll be a lot of people buying in down at the low of the base, where I tend to buy. So they've already made 15 or 20% on that. So some of those people will be exiting as some of that volume kicks in, and that's why it can be a little bit volatile around. And you see quite a lot of them have false breakouts. If you're already in the trade and you're trailing out you got a trailing stock following it up, then you're not in any danger at that point. But if you're just entering in, you're probably going to get shaken out. So they are possible, but you really need to have all the classic breakout signals if you're going to trade them at the classic entry. And for exits, essentially I always exit on my scale points and via a trailing stop. I've not seen a better way of doing it, but everyone will have their own exit methods. But I like to get out at 10% and 20%. If we're in a good market, or 5 and 10 if we're not. But generally, because I'm buying at about a 20% replacement, my second scale out is normally at the same point as the classic entry. And the good ones are when you just scale out, you've still got half your original position left on, and then the thing takes off to the moon. And that's the ideal position. And if it doesn't, if it fails, you've taken your second scale out anyway, so you still made a handsome profit on the trade. So how do we find them? This is a stock chart scan that I use. Everyone will have their own scanning engine. But essentially, what we're looking for is this stock charts. We look for a 3-month gain, so a maximum high of 60 days ago divided by the close times 0.99, and then that essentially gives us that 99% plus. Anything that's moved up with that, bring that into play, and then a 25% pullback. So you look at your bit of calculation there, but looking at it over kind of 25%. It's difficult for me because I don't use MarketSmith or any of those other tools, so I don't know how you would necessarily write those scans in there, but I'm sure you'll be able to translate it from there. So let's go and have a look at some charts, shall we? What I'll need to do is get out of this. Now, has that chart come up? Confirm yes or no.
SM?
Yep.
Yep, I see it.
Oh, brilliant. Okay. Right. So this is one I showed you guys earlier, but I'll zoom in on this. I'll take a look. This is essentially the pattern, that big move up, decline, move up, decline, move up, decline. So if I delete that, okay, let's kind of zoom in. How it looks on this sort of day to day. The way that I generally look at things is I use the timeline. So the high, when I'm looking at this, I'm seeing the high has come up here, 14th of December. So I'll go back basically to the lowest, the pivot point. You could always go back two whole months. So you could go November, October, and say what's the pivot point after that, and that would be down there, and that would give you your move. So it's moved like 400% there, and then you're looking at this decline of what is it? As I say, these can be a little bit wobbly, but you'll see here, and oh damn it, let's Control Z that. Trying to zoom in here a bit better because it auto kind of draws and all that kind of stuff. But essentially, what I am looking for here is this, this sort of 15-day range that we've got here. You're looking for this being less than 25%. You can see what I would say about the averages, that price goes way above the averages, then the averages all start to kind of close up. Now this one happened a bit quick and we went, but also at that point you can see these range declines. So the volume is coming in, which we like to see. So we like to see that volume coming in. It was going up on the way out, which is great. this is the ATR. Now this is a, if I click that's a 14-day average true range indicator. That's all it is. And we can see that the range is declining as well. And that's what we tend to refer to as a volume range decline. Those two particular things together show me that the volatility in the stock is declining. And then essentially we're looking for somewhere around here that we can get a breakout. This one's set up quite nicely with this little kind of pivot point here, and we went. Now, if you were buying at the classic O'Neill entry, that would be here. It still wouldn't have been a bad entry. And see what you can see about the volume. If you're buying at this top entry here, which would be 708 on the 5th of January, you've got the massive volume surge, and that's what you're looking for if you're buying on that classic pivot. You need to have this biggest volume yet. But if you had a wee volume bar down like this, then it's probably going to fail. And then what happens very quickly after that, remember I said these things often set up again and again and again. Literally, we have 1, 2, 3, 4, 5, 6, 7 days, and it moves 100%. So in a week. And then it starts to set up yet another nice high tight flag, and we get that nice pullback in, and then it sets up yet again, and again we have volume coming down. And if I could zoomed in on this range, you'll see that there's actually a range decline down here, and then it kicks up when it takes off again. Similarly, again, we get the averages flattening out. So the 10-period moving averages flattens out, starts to curve down. The 21-day comes down, so we start seeing price in and around those two averages. Same down here, price is moving about them. The 50 periods get a chance to catch up, and off it goes again. And it does exactly the same again. It makes another 150% move. So, and at this point, I was thinking, oops, at this point here, you'd still be, you're looking at it, say, what's it going to do now? And this time I did put an entry in here. This is a long, messy one, so this is always kind of broken. But this is where you're saying, is this turning into a rocket base here at this point? Because we've got a range decline, which is fine, but it's too long in the pattern now. So we're having a look, and if you kept an eye on it, I tried it here, and then obviously that didn't work. It stopped out there. For whatever reason, I obviously took my eye off it. But then again, it kicks off again from this pivot down here. Oops. Doesn't make quite the same amount of move at that point. I don't know what that went to. That's 40% move. So it's still not bad, reasonable. But yeah, and that's the basics of the high tight flag pattern. If we look at some other ones, trade, so yeah, here's another few. I'll go on to some of the more recent ones from this week in a sec. But again, you can see, I think I need to click that adjust off. Yeah. So what we're looking at this point would be, again, here's our move. Time period wise, I'm not sure what that is. 27th of Jan, 12th of March, 6 weeks. Then we get same old pattern. Here we go. There's our high point. So because on our watch list, we'll scan for it, and it'll pick it up, some point in this week. And we watch and we watch and we watch. And there we go. We have volume declining. We have a range declining down here. We have a pivot point that we see, we like it, we get in, gives us, I don't know what our stop was in there, somewhere less than 5%, and off it goes. Now this one doesn't go necessarily all the way to plan because we get stopped out down here, but it goes up, and it doesn't quite make 100% move, this one, 85% or so, but then it does start to set up again. So we start looking here. Now this is quite messy. in terms of range decline because you got this big bar here, with this tail sticking down. I don't know what happened there, but I decided to give it another shot and got a couple of little bits out of it here, and then that one went off. But that's another one. I don't want to overdo it, so I'll have a look at some of the ones that were from last week. Tick flag, where the archive 2022 trades. So there's a few here. Try and go to the end. RYI, first one that I was in, and I got taken out of that on Friday. Yesterday. In fact, no, it wasn't. It was Thursday near the close. Actually, it came out. But this one showed up on my scan. So here we go. We've got 121% move from the end of January through to end of March. So that's our kind of 8 weeks. We have that decline as it comes in. All bits are in place here. Volume's going down. ATR is going down. And we're looking at that. Watching here, we get a nice low cheat that pops in here. So this is where I took a pop at it. Wasn't sure if this was going to win or not. I'm sure this is on day 15 itself, if I remember rightly. From there to there. Oh, no, it was a wee bit early. So anyway, took it a little bit early, but this looked too good to miss. And off we went, and then we got our 10 scale out, our 20% scale out, and there we are. There's the classic breakout. So we've got our 2 scale outs at that point. So now we're riding a backstop, and it kept going up, and then the last 2 days, obviously, it's just reversed down, taking us out just above that classic entry point, but made some decent money on that trade. So that is now off the list. Two days in a row. 1, 2. This bar here is why I moved my stop right up and then got taken out, because it was 1, 2, 3. That single bar took out 3 days previous closes, so that's an immediate danger point that is screaming red alarm buttons at us now. So there we are. Saved a little bit on that. Car is another one that I took. Again, you can see these high tight fly. They come in different flavors, shapes, and sizes, but the same basic anatomy. 100% move. From there, we have immediately we see a nice volume and range decline. Volume decline. Range goes down, and we're kind of looking at it here, but didn't go as a little bit early. And then range is declining again, which we like to see. And then we get this nice little low cheat point in here. As you can see, averages have kind of flattened out, come together. Price is playing with the averages. 50 period is caught up. Let's have a go. And we go reasonable stop, 5%. Below the previous day's high, which is even better. We scale out at the classic point. We get a further scale out on that same day, and then it reverses back. Now, this is what I was saying is the issue. If you're buying this at the classic entry point, you're in here. You may have had one scale out, maybe not, but if you've moved your stop up to break even, you're now out. If you're not out, you're wondering, do I hold it or do I get rid? And you're not quite sure what to do here. Whereas we've bought from this kind of 15-day point low down here and find the next available entry after that. We're in here. So we're actually pretty golden, because if we're using a trailing stop at the 10 or something, we've taken 2 scale outs. So trade management becomes much, much easier for us here. We don't have anything other than further profits at risk. So that's 2 from last week. I think this was also a high tight flag, which didn't work too well. this is one that I bought at the Classic Pivot, and the reason for that was I'll kind of go through it. So nice, we get 250% move. It's great, right? Stock's got momentum. We get a retracement, 15 days, and I was sort of looking at it here, but this bar here to me is a red flag, and because it's more than a 4% decline on the day. So I elected to wait 6 days after that, which took me to here, which it was ready to break out at this point. So that's where I just bought the classic breakout, managed to get one scale out, moved my stop to just under break even, and got taken out the very next day. But the same thing is that the pattern's good. We've got the volume decline, and there, and down here we've got the range decline. It's pretty slim, but it's at least it's there. And then we have just this horrendous bar, which is a pile driver of a bar, and just wouldn't look at this stock for a long time. But it's a biotech, and that's what happens in biotechs. I mean, the biotechs are insanely volatile on the least rumor or news that we as traders probably never hear. So essentially that was my quiz through on high tight flags. If anybody wants to see the scan, I can to this. So if I go and do my weekly high tight flag scan, so there, I'll run it. We've got 62 potential high tight flags, and I know all of these will be because this is just a scan that's picking up the first part of the pattern, which is, has it moved more than 100% in the last 8 weeks, and is it now starting to decline? So some of these will already be on my list, and others won't, but so 62 in there, save that into a high tight flag list. Just there. And we can have a wee look, see what we've got. So you can see already we've got some that are broken, which we just take off the list, but others that don't look that great on these little mini charts, but they may well be. And I basically just kind of go through these, get rid of all the obvious stuffers, and then look at the ones that are looking quite good. So answer good questions. This one looks good for watching. 24. If there's no questions, I'll pass back to you.
No, that was fantastic. Thanks, Stu. Yeah, I actually have a couple of questions. I was taking notes as you were going along. So to go back to the beginning, when you were talking about the percentage that price needed to move and the weeks that it needs to consolidate, like it seems like there's a little bit of wiggle room in when you might take it, right? Like at least as far as the 3 weeks part, right? Like you took one that was that had several other elements that were great.
Yes.
That you took it on day number 11. Like, is there wiggle room in the percentage move too? Does it have to be at over 100, or if it's 95, that's okay, or if it's 80, that's okay? Like, well, is there some kind of a line in the sand where it's just like, this doesn't qualify?
So I mean, so the 100% is pretty much a line in the sand for me. If it comes in at 98.7 or something, then I mean, you can allow that. I'm sure most of them are over. To be honest, but if it's in the 80s or low 90s, then it's up to the individual. You'd need to do some analysis on that, but it just wouldn't appear in my scans, which is why they're kind of the ones that lead me, if you know what I mean. So, you know, if it's not made 100% move, then the scan's not going to allow it through. So I'm not going to see it.
At what point is it no longer a high tide flag when it goes past the 20-day? In other words, at what point does it become a breakdown instead of a high tide flag?
Yeah. So anything in this part here, so if it goes more than 8 weeks, it's no longer a high tide flag. So if it gets to this point 8 weeks after it's high and it hasn't gone higher, then it's not a high tide flag, it's broken down. And if it goes below 25% retracement, it's no longer a high tide flag and it's broken down. And they are pretty much hard lines in the sand for me. I tend to lose interest if it's gone 5 weeks in its retracement and not showing me anything that's tradable. But if it goes down more than 25%, even at 25.5, then I'm treating it as a rocket base and I'm throwing it on the back burner and treating it differently. So, yeah. But the best ones are all somewhere between 15 and 25%. Is where they bottom out, and the best ones, you know, if you wanted to trade it exact and say I've got to see 15 days of retracement and it's got to be no more than 25%, and then I'm looking for setups, then you will not go wrong. And as you get used to seeing them, then you pick it out. But if I see any, if I've got 4 or 5 that I'm looking at, and one is got 11 days and it's starting to look something's tradable there, and one is 17 days and it's tradable, I'll pick the 17-day base.
So it can go beyond the moving average. It's just a matter of percentage then instead.
It is, yeah. The moving averages are just a quick and neat thing. I mean, they'll often undercut the 21-period moving average, but very rarely would it go underneath the 50 because of the way high tide flags work, because the 50-period moving average should be down here somewhere in this area. And if it cuts under it, then it's more than a 25% retracement. So therefore it's not a high tide flag, if you see what I mean.
Yeah, I guess I was just thinking that it might hug the 21-day or something like that. But
oh yeah, they often do, and that's my favorite place to buy them, to be honest. Yeah. I mean, you know, if I was to bring up TradingView, you know, it's not the greatest example of that one. Cars not. But yeah, I mean, this bit here, this is a really good example. Forget the fact that's 11 bars, but the way that we have the 10 periods coming down, the 21 period is flat and they're squeezing together, and the 50s coming up. That's where you want to see this squeezing together, this kind of bit here. And very often beyond on my chart, the 21 period is this green area here. So in this green area between the 21 and 50 is often where you get the best entries. And it squeezes right up, and that is, you want to buy it as it's coming out of that squeeze, basically. If that makes sense. You know, if it's messing about up in this area here, then I'm not that interested in it at that point up here. But that, you know, even if you took all the price bars off that and just looked at the moving averages, it's these points here where these averages squeeze together. That's where you want to buy. Yeah, but I want to buy anyway.
Stu, could you bring up OXY?
XY Oxy, yeah. Yeah.
So I bought this on Thursday as it was breaking out over 63.25 or whatever it was.
Yeah.
And then then was stopped out on Friday. And
Yeah.
I saw this as a high tide flag.
Yeah,
What could I have done
might be.
better or differently?
You
So I
said
was,
behind.
yep, that's where I was looking at it from.
Oh, okay. That's your buy points here.
Okay.
So, you're looking at that and that, yeah. I mean, that's the classic breakout that you're buying, essentially. But and the problem with those is, if you don't get the volume on that bar, which you didn't, I mean, slightly above average, but it's nothing like what it should be. If that breakout was going to work, that should have been a monster bar. Yeah, this one here.
An uptrending market, it would be a second mouse trade.
Yeah.
Back on Friday, which would be the place to enter.
Yeah, and it may come down a bit. What have we got? Yeah, it's only 4 weeks in, so. But yeah, I think I can take that. This is potentially where you would be looking to buy, but it just didn't set up very well. This one, I don't think, to be honest,
Why not?
because it's not a nice clean retracement and then up. It's again, it's, I don't know what that was. Was that 12 days? 1, 2, 3, 4, 5, 6, 11. That 12, 13, 14. So this is the 3 weeks in, and this is where you want to see the low point, about 3 weeks in. So it's just not. You just see if it had come down like this to about here, and then you had some action in around here. That would have been how it would have.
You were never really seeing that much of an increase in volume.
No, volumes, not great.
So the low point in the base should be at least 15 days out, and if it's not, does it then constitute a flawed pattern and something you would not be interested in?
It doesn't have to be necessarily make it a flawed pattern, but it's just a lower probability one. So the highest probability you'll get is when that low of the base is in that third week of the retracement. So it doesn't necessarily have to be on day 15, because I think that's asking a bit too much. But somewhere in that third week is that low point on the base, and then you see a slight, you hear me talking about things. I like to see higher lows, and it can mean all sorts of things to different people. But if you look at look at, so what I like to see is that low of the base, and then some higher lows, and then you get these little pivots, and that's kind of where you want to buy. You see what I mean? So the low of the base was actually there, which is day 14, something to the low of the base, and then you start to see some of these higher lows coming in, and that's it's creeping higher. The volume's not going up much, so there's no sellers ain't getting any traction because there's nobody want to sell it at that point. So that's giving you all the clues that this is going in, and again, moving averages squeezing together.
And that's where you'll look to buy in the low cheat within the base.
Yeah.
Will you buy the classic pivot in a high tide flag?
I do. Sometimes that's what I did with this guy here. Which I got a scale out and a just below break even stop on, so made a little bit of money. Didn't lose anything on it, but again, there's that element that it just didn't work out. So again, I was 15 bars, and then looking at this one didn't offer a great entry for me down here, so that's why I looked at it on this kind of classic O'Neill breakout. But it was tricky getting a decent stop on this one as well. It's quite hard to get something in there.
So when you have a reversal like that and it doesn't take off and go, what are you looking for it to form a rocket base?
Well, rocket base is a whole other thing. That's a whole different topic. So
And perhaps we could do that one next week.
Yeah, that might be an idea. Yeah. So essentially when a high tide flag breaks down, like this is done, I suppose in a way. I'm guessing that's more than that's 38%. So, so when it either goes beyond its 8 weeks, from its previous high, or goes sub 25% retracement and above kind of 40. Then you expect to see a long base, and what you tend to get is you get your sort of typical cup and handle type things that you would see in an O'Neill base, but what I'm normally looking for is the second pullback. So what, and without taking up too much time, but what often happens if I draw over here is price comes down, and then it kind of bimbles along at the bottom, and then you get an up and then a down, and then on this second pull back here and then up. Okay. What I normally look for is to come up, down, and then it's at this point here when it starts retracing. This is when I'm interested in a rocket base. So it's a bit like your VCPs, if you like, So it's kind of come down and another, but it's this second retracement that I tend to look at in a rocket base. And not all of them give that, and not all of them do that, but it's just one of the places that I've found that it can be worthwhile buying. But they can lead to explosive moves upward as well. And it normally happens really quickly, which is why they're sort of known as rocket bases, because all of a sudden they regain their mojo that they had lost, all of a sudden. And they do seem to be in sort of 3 to 4 months after they've kind of lost it, So it's probably something to do with earnings and all those types of things, I would guess.
So Stu, looking at the chart that you're looking at now at the bottom, like around February 22nd, and that would you look at that as a rocket base setting up because you kind of went up, pulled back?
No, because it's got to have made that move of more than 100% to start with.
Oh, okay. Okay, great. Thank you.
Yeah, those sort of rocket bases, as well as I term them anyway, are essentially failed high tide flags. Okay. So high tide flags that for whatever reason, whether it's time or retracement depth, have not panned out. So therefore, I'm putting them on the kind of rocket list to see if they repair themselves, I suppose, at the end of the day. Because it's a similar setup and a similar trading style that you probably know well enough by now that I tend to trade the same stuff. I don't change it around very much. All right.
Earlier in the presentation, you had mentioned that there's a high probability of success with these.
Yes.
From like 45% of them go 30% or more.
Yes.
Is that personal experience or is that Polkowski or
Yes, Bukowski. Let me
both?
find him.
What's your experience with it? Does that end up being true?
Yeah, absolutely. And if you're so if you go onto this, the patternsite.com, and you can look up any of these, and we'll look for chart patterns. And you'll find you'll have somewhere down here. It'll tell you what they are at the moment. It does it every year. So they, and you can go into as much of the, failures, 15%, average rise, 39%, throwback rate, percentage meeting the price target, 82%. So, you can go in there, and he just updates these stats, and so it's kind of automatic. So, yeah, so that's based on essentially where he his stats, and that's kind of borne out. Doesn't mean you can just blindly go and see something in a high type flag and buy it and expect to make money. You need to buy it at the proper place. You need to make sure it's a valid setup. You need to have appropriate risk management, trade management, all that other stuff. But you will do there. I mean, I should change that to 82% chance to go 30% or more. But yeah, and that's these are just the reasons why. That's why I started focusing on them and why I like them. And they come along in series and sets. For the best part of the last 8 months, I think my scans have been picking up the low teens or single digits of stocks that are meeting the scan criteria. And it's only over the last 5 weeks that started to creep up into the 20s, the 30s, 60s, 70s now that we're seeing. So, so it's given those stocks a chance, obviously, to make those moves. And then start to retrace them. That's where my scans are starting to pick them up. At the height of the market in 2020, scans were picking up over 200 a day, and there was huge quality of those as well. So, but then all of a sudden they just dry up, So it's
in a downtrending market like this, I think the probability of these working is a lot lower.
You would think so, wouldn't you? But remember, this is based on individual stocks rather than the market. So as you say, in any market, there's other things that are going up. So the ones that are popping in have been like steel stocks and these other things that are they've obviously been growing over the last 2 to 3 months. They've had those moves, and if that market continues in that way, then there's no reason why they won't actually work. But then, as you say, at some point they will just stop working and they'll stop showing out. But if they're not going to work, then they'll retrace more than their 25%. So therefore, they'll be busted patterns anyway. You wouldn't be trading them. So, and a new lot will come around, but they're not constant feature of the market. They come in quantity and quality as well. So.
Well, I would agree. It depends on the sector you're in. If you were in defensive stocks, they'd be more likely to work right now.
Yeah, I mean, if you look at the ones that are shown up on my list, on my dashboard, let me go to my high type flag. Let's view that as a summary. If you look at the industries where they're showing up, energy, materials, basically. Down here, some marine transportation stuff. So, yeah, coal, for some strange reason, lots of coal stocks are showing up there this week. So, yeah. So yeah, I mean the sectors and the industries will swap around, yeah, depending on what's what's currently working and what's not. So, but I haven't found it the case just because the market's in a general downtrend that your individual stock with its setup doesn't work. We kind of have been. Maybe not as well. Certainly not as easy pickings as 2020, but yeah.
I think you answered a few questions in there. I think, see, Anthony had asked a very similar question if the about market conditions and how high type flags would work. So it really depends on the stock itself and the quality and the sector move.
Yeah.
It sounds like if I'm hearing it correct.
Yeah, absolutely. I mean, and that's, it's just that is the price action in that particular stock in that sector at that time. It's not based on what the markets are doing. Cool.
I've got one more question, Stu, and then if nobody else has other questions, we could let you out of the hot seat. But this has been sensational. Thank you so much for doing this.
You're welcome.
So with the volume, Oxy was a fair example, or maybe there's a better example where it breaks out and volume is okay, like it's a little bit above average, but it doesn't quite have the punch of the run up. How do you handle it? Like, are you selling it right away? Are you moving your stop up a bit more aggressively, like playing it out? Well, how exactly would you handle it?
I just handle it the same as every trade might. My theory. I mean, I never know which one's going to be my next big winner, so treat them all the same, really. I don't actually do anything different. I mean, the volume's not there then, and I've already placed a buy order and it kicks in. Then I will be looking at it a little bit closer, for sure, and I may certainly be looking to tighten my stop up at the end of that day. Which I normally do anyway, but if something's jumped up 10% and you've taken a scale out, you move your stop to break even. If it's only gone up 2 or 3%, often I'll put an alert in at a slightly higher level, but not necessarily move my stop. But in the case where, as you're saying, with it, if you're buying a traditional flat top breakout and there's no volume there at all, then I might well look a little bit more aggressively. I don't have a hard and fast rule for it, I suppose is what I'm saying, Mike. It's kind of situation dependent.
Okay. And it looks like there's another question from Anthony. He says, well, one other question I have is there something you look at in the sector or ETF that correlates with the high type flag that you're looking at? For example, the miners had some good high type flag setups that rolled over last week. AA is an example.
Yep, it was one I was looking at actually. Bring that up just to see. I thought AA was still in play, to be honest. Maybe not. Let's have a look. Let's look at AA.
I would argue that just about everything rolled over last week.
Yeah, that was one I decided not to, because it wasn't a proper high tech flag. It didn't have the move. Yeah, but it never actually really took off. That one, yeah. That was always marginal. There was better setups around at the time. Yeah, I think you're right. Everything did roll over last week. So, but yeah, there's no good buy points on that yet at the moment. I think I was certainly looking at this on last week because I thought this bar here on the earnings, I thought the next day would have been probably a good, just at the top of that purple square that I've marked. kind of looking at that, but it's not actually really a valid high tide flag. But to answer that question, I don't look for anything in the sector or ETF. Doesn't kind of come into it for trading these. I'm really just looking at the pattern that's in front of me and based on the quality of that pattern. There's a few things here that give you a little bit of a worry, especially on this kind of pull bit as well. This deep pullback down here. Often you'll get pullbacks in a pull, but they tend to be more horizontal rather than deeply coming down like so. So that'll give you a slight cause for concern, and it really didn't have enough oomph, and then it pulled back then a bit more. But the more you look at these things, the more you recognise the good from the bad. And I think the other thing I would say to anybody that's scanning and putting these things, these are not something you put on your watch list on day one and then can trade it on day two. They have to sit on your watch list for 3, 4, 5 weeks. So you can't refresh your watch list all the time. You have to add to it. So just be aware of that, because they do take 3 or 4 weeks to actually set up, and you're looking to get them on your radar, as soon as possible in the first couple of weeks. Well, certainly I do, because of the way my scanning engine works. So you'll often have a biggish list. As you can see, I've got about 90 something on my list. So, and you just got to watch them and just go through them every few days and prune out the ones that have broken any of your rules, and you should be left with the ones that are good.
So Stu, you had Hudson on your list. What did you see in that?
Hudson, where's that? Where's that? Do you know the ticker, Tish, offhand?
HDSN.
Okay, I've got it on my list, have I? Oh yeah, this one's just starting out, isn't it? I haven't actually gone and done my moves yet. So. Yeah, that looks okay. What's that? Yeah, so it's that would be the. So yeah, 100%. Yeah, it's got a long way to go yet. So that I'm waiting 3 weeks here, Tish, roughly, to see what it does. TradingView's got a little date range thing, which is quite good, so you can pop up. So you just kind of watching what's happening in this space here. We've got earnings in the middle, so we'll see what happens. But yeah, you'd be looking for that to. It's not the most auspicious of starts with it dropping 15% in 2 days. So if it comes much below that blue line, then it's broken already. So, but we'll just watch it and see how it works.
Okay. So do you ever like the 2 days that were because of the market, do you ever take that into consideration that that was the market and it really wasn't the stock that
No,
that had a bad day? Okay.
I don't, because if it was a really, really strong stock and the market sells off for 2 or 3% or whatever, really strong stocks don't sell off.
Okay.
And that's the whole relative strength thing, I suppose. So yeah, so I just treat each, and if you can always find excuses to break rules, but the reason you put rules in the first place is to save you from making errors, and to protect your capital and to save you from yourself in a way. So if you start making excuses for things, then you just thrown all that good work you did out the window. So I know it sounds, it's easy to do, is to try and make in this instance I'll do that, or in this, but sometimes the rules are there for a reason, and it's, at first it seems quite hard to stick to them, and if they're too hard to stick to, then you made the rules, so you better change them so you can stick to them. So I stick to my rules generally, and this one here, I mean, I wouldn't trade this now for 6 more days, even if there's perfect setup staring me in the face, just because I've got a rule about that. But yeah.
Okay, thank you.
Does that make any sense?
Yeah, that's great. Thank you. Great reminder.
Yeah. I mean, it's you often put these rules in for a reason, and then you forget what the reason is because you've had them for a while, and then you think breaking them might be okay or not. But
I just want to point out the obvious, because this is how you trade pretty much anyway, but you have a higher probability of having a good outcome by using a high tight flag versus trading breakouts, because you have, psychologically speaking, a lot of people getting into a trade in anticipation of a breakout. So you've got all that room to run into the breakout point. Maybe the breakout will work, but maybe it won't. But in the meantime, you've made a little bit of money trade up to that point.
yeah, absolutely, and that's that's what keeps me keeps me trading them, I suppose, because I'm already made profit as other people are just jumping into the trade, So yeah, but yeah, that's absolutely right. The reason for trading these is because there's lots of other eyeballs on these things that are wanting to buy it. So. All right, Mike, I shall hand over to you now.
Yeah, fantastic presentation, Stu. Thank you.
Glad you enjoyed it.